high dividend yielding stocks might not be the best investment. Hello everyone, my name is Joel and today we're going to be talking about high dividend yielding stocks. I want to go over 3 reasons why they just might not be the best investment for you. Of course, there are exceptions for everything, so there are some high dividend yielders that I think might be good investments. So we're going to go over the things you need to know and analyze before ever purchasing a high dividend yielding stock, and then we're going to go ahead and look at a few high yield dividend stocks that I think might be good investments and one that I even own. First, let's start off with the 3 reasons why you might not want to invest in high dividend yielding stocks. The first one is limited growth potential. These stocks usually that have these high dividend yields above 7%, 10%, some even higher than that, usually do have these high yields because they are paying a large portion of their profits out in dividends. That means that most of the money that company is making, they're giving back out in the form of dividends. This can really limit the growth potential of that company. For example, tech companies pay very low dividends and some don't even pay dividends at all. This is because they're reinvesting all of their profits, all of their money back into research to push their company higher and their product higher. Now investors look at this and see good growth potential, incentivizing them to invest in that company. Now with these high dividend payers, really the only incentive is that high dividend payment. They aren't reinvesting that money back into their company, or at least not very much of it, so usually these companies don't experience as much growth. The second reason is lack of diversity. Because of that lack of growth, there aren't that many different types of companies that offer high dividends. The most popular two are REITs and MLPs. REITs are real estate investment trusts. Now these just invest in a bunch of real estate and then lease or rent that real estate and make money that way. And these companies pay out a huge portion of their profits in dividends. Now MLPs are master limited partnerships. And these are companies that usually own a lot of energy assets or pipelines or even storage units. So this is another group of company that just owns assets. Now these companies obviously don't need to reinvest a lot of money, and that's why they pay such large dividends and receive tax benefits for paying those large dividends. But in an economic downturn, if that sector has a downturn or the Fed increases the interest rates, these companies can really take a hit. So that 10% dividend might actually turn into a loss if that stock price is falling, because that's 10% of whatever that stock price is. So if that price falls enough, that 10% dividend isn't even going to be enough to make sure you have a solid return on your investment. And the third reason is a lot of times there's inconsistent dividends within these larger dividend payers. Some companies might be paying a large dividend right now, but they might have to cut back that dividend. A lot of times even cut it in half. If there is problems with that company, if they're not making as much money, then they'll cut that dividend payment. This is risky, and then if these stock price is also dependent on that dividend payment and they cut that dividend payment, that can be less dividends and that can affect the stock price as well. So that can be a major loss for you. You really have to look at the risk versus reward while investing in large dividend payers. Now of course there are some high dividend payers that might be good investments. When you're looking for these good investments, there are a few things I want you to look for specifically. Number 1 being the market cap. How big is the company you're looking to invest in? The bigger the company, usually the safer the investment. The second thing you should look at are the earnings. Is this company making money? If so, that's probably a good investment. And the third thing is the dividend payout ratio. How much of that money, how much of their profits are they paying out in dividends? If it's a super large percentage, that is going to be limiting and that is going to be more risky. The fourth thing is the history of the dividend payments. Has it been a consistent dividend payment, or is it fluctuating, increasing, decreasing regularly? You want something that is consistent. You want to know what you're going to get. And the fifth thing is the PE ratio, price to earnings ratio. This means how high is that stock price compared to that company's actual earnings. And when you look at this, what you really want to do is look at other companies within that sector and compare the company you're looking at to other companies. Most investors, kind of a safe rule of thumb is a price to earnings ratio below 15, but it really does depend on that sector. So if you're looking to invest in a REIT, look at other REITs' PE ratios. Okay, now I'm going to show you 2 examples of high yielding dividend stocks that I think might be good investments or that I might own, or at least are good comparables to other high yielding dividends. So let's start off here with ticker CIM.
This is a REIT, and as you can see, it has a market cap of 3.5 billion, which is decent. It has a PE ratio of 14.97, earnings per share is 1.28, and the dividend yield is $2 or 10.5%. Now, I personally don't own this company, but I do know that a lot of people do own it, and I see it in a lot of people's recommended kind of high dividend yielding portfolios. But for me right now, it's just a little bit overvalued. I haven't done too much research into the fundamentals of this company, so it's not something that I'm going to be buying anytime soon. But there is a high dividend yielder in my portfolio, and that is, of course, AT&T. Now, AT&T is in the telecommunications sector, obviously, and so it's not one of those REITs or MLPs, and it has a 6.29% dividend with a $237 billion market cap and a PE ratio of just over 12. Now let's go and compare that PE ratio to maybe another stock in that communication sector, and that is Verizon, with a very similar market cap and a slightly higher PE ratio, and then a smaller dividend yield. So as you guys could maybe tell, I'm not huge on high dividend yielders. I think that there's a sweet spot for dividends that you don't want it to be too high, because I like to accumulate both the growth, capital appreciation, and the dividend payments in my portfolio. But there is one, and that is AT&T, that I do own, and I got in, around $29 a share, which I felt like was a good value. Too good to pass up for something that's going to pay me a 6% dividend. Now, with all that being said, I am not a stock analyst nor a financial advisor, so these are just my opinions and the things that I've kind of learned about the stock market and high dividend yielding stocks. But these are two solid comparables for any other high dividend yielding stocks.
Now, I want you guys to be careful when you're considering purchasing a high yielding dividend stock. There are some that are going to be great investments that are going to pay you those dividends and maybe even have some increase and growth. But you really need to do your research and look at the fundamentals of these companies. The last thing you want to do is lose money over 10% dividend, especially when there are growth stocks giving you more than that 10%, and there are stocks that pay lower dividends but also have significant growth. With all that being said, thank you all so much for watching this video. I hope you found it helpful. Please consider giving this video a like, and I look forward to seeing you in the next video.